Hi, I'm Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader. I'm here with your Cabot Weekly Review. Net on the market, I'm recording this late Friday morning, Friday the 13th. It's been another down week for the indexes, down week for growth stocks. Monday and I think Wednesday were really pretty bad. And really every day this week we saw some sort of blow up among a potential leader or a former leader, just, another 20, 30, 40% decline type of thing. Now, we have seen some support here later in the week, so we'll see how it goes. As I'm going to kind of get into here in the charts, we really are seeing some, you know, extremes, oversold sentiment, whatever, especially with breadth that, really haven't been seen or they've only been seen a handful of times in the last 30, 40, 50 years. So the rubber band is quite stretched. Plus, of course, a lot of these stocks are, they could rally 50% and still be way below all their moving averages. So we're quite stretched to the downside. And hopefully, I hate to use the word hope, which is a four-letter word in the market, but hopefully Thursday afternoon and this morning, where we're up pretty good here on Friday, hopefully that's the start of some sort of bounce. In terms of, what may happen, I'm not even going to go there yet. Let's just get off our knees first and then see whether it's a workable low, which is I think we can have, meaning the market can work off of it for a few weeks. Maybe we have to retest. Maybe it doesn't work. Maybe we just blast off. We'll have to see how it plays out. But I think right now the conditions are in place for a low. We just have to see more up action here, more than just a day or two. We need to see some stocks shape up and that sort of thing. Right now, obviously, the primary evidence remains negative, so we remain highly defensive. In Cabot Growth Investors model portfolio, we're north of 80% cash, which honestly I'm never comfortable with that much cash, just because usually if we ever get there, it's near a low. Not always, but oftentimes. So we'll see how it plays out. I'm not opposed to doing a little nibbling, but really, and for no matter what kind of investor you are, I think keep your eyes on the prize, which is the next sustained uptrend when new and fresh stocks can go up for more than 3 or 4 days, and they gap up on earnings and they have 6, 9, 12-month runs as Fidelity and T. Rowe Price pile into them. That time isn't here yet, but hopefully we're going to kind of put a little bit of a line in the sand here and see how it goes. Okay, now let's hop into the charts. I'm going to start here with stockcharts.com. It's a free site with ads, but you can also subscribe, which we do for a modest fee. It's a great site if we use it all day long. I just wanted to show you one example. I mean, you could look at new lows, you could look at percent of stock, bullish percents, all sorts of breadth measurements. But this is one I wrote about in the CGI update, and I think the top 10 update today. This goes back 20 years, and this light sort of red and black line here, I've sort of made it a little duller, is the percent of all NASDAQ stocks that are above their 50-day line on any given day. And take my word for it, we're down here as of yesterday, it was like 7%. And you can just see, maybe you can't see because the chart's a little bit hard to see on this, but it got worse during the pandemic crash, obviously. But the 2018 low, it's below the 2015 and 2016, that sort of stealth bear market low. 2011 was a major low. 2008, I mean, it's didn't get much lower than that, maybe another percent or two. The 2002 bear market, this got as low. So even on just a daily basis, it's very, very extreme, okay? The other thing too is just it's the depth of selling. It's not like we just had a crash. It's that the Nasdaq topped out 6 months ago, which is an important thing. Time is a big factor in the market. And this thick blue line is basically just the 200-day moving average of this indicator. So it's basically saying, hey, over the past 200 days, over the past 9 months, on average, how many stocks or what percent of NASDAQ stocks were above their 50-day line on all those days? And as coming in today, it was, 33.3%, so 1/3. And you can just see, just going back here, it was below the lows here. We don't have enough data here for the 2000, 2003 bear market, but it probably matched those lows. And it's basically matching the lows here of 2008. Okay, so it's been a long, bad stretch for the NASDAQ broad market. Now, obviously, the NASDAQ is worse than the New York, and the New York isn't quite as extreme. So we'll see how it goes. But my point is, looking at stuff like this, or I think it was something like 30%, on average, 30% of all NASDAQ stocks have hit new 52-week lows every day for the past 5 days. Again, it can get more extreme, and it did, like during the pandemic and all that, the crash. But it's right up there, handful of readings. So yes, you can always get more extreme, but my point with this is more just saying that, we really are seeing really, really rubber band stretch sort of thing. So let's just see, hopefully we started bouncing. Let's see how the bounce goes. Now let me jump here. Let's see, window capture. Let's hop back into MarketSmith. Okay, so now we're back into MarketSmith. This is a product from Investors Business Daily. You can learn more at marketsmith.com. Just going through the indexes here. So you can just see even during, get the line pen up. So obviously high to low, the NASDAQ, this is the other thing I wanted to mention. So from high to low, the NASDAQ has fallen about 30%. I think it was like 29% into Thursday's low. The average maximum drawdown for the stocks on that exchange is 50%. Same thing with the Russell 2000, 50%. Even among the S&P 500, the average stock has fallen a max of 28%. All this is a long way. It doesn't mean it can't get worse. I'm just saying all this is a long way of saying, like, this is clearly a bear phase in the market. Whether we bottom here, it takes another 2 months. But like I said, the eye on the prize is when this is over, this is a real reset. The way I like to think of it, instead of using bear market and all those terms, is just it's a reset. Okay, we're flushing out all the old excesses. We're going to start fresh and kind of create our own new excesses in the next run, which is where the money is made. Okay. Anyway, you can see the NASDAQ here. The 50-day line is up here at 13,200. Even as I record this, it's probably 1,500 points above where the NASDAQ is now. So there's a lot of daylight there for a bounce. Let's see. It's been not even a full day of bouncing. So obviously the trends are still down, but we'll see if this thing can kind of stick. It wouldn't surprise me if we do get off our knees. It's just been so almost climactic selling here of late. The way I like to think about it is if we had bottomed in the NASDAQ 6 months ago, had a huge run into January, chopped around and really ran here, and we had 2 or 3 stocks every day gapping up 30 or 40% instead of gapping down, it would be a little short-term, blow-offy. So, let's see if we can bounce here. This is the S&P 500, still buried, but obviously extended to the downside, even well below the prior lows. Let's let IWM, small caps. It's all pretty much, everything's pretty much back in gear. Not saying it's good to be in gear on the downside, but it's not so many divergences and that sort of thing. That's the IWM Russell 2000. Here's the mid cap, same sort of thing. So there's not really too much to read into it. We've sort of had this meltdown post the Fed. We've decisively broken the lows. We have terrible sentiment and terrible breadth reading. So bad, maybe it's good, but let's just see if this bounce can develop or not. Okay. Just basically running through the charts. There's not too much. This QQQJ, again, growth stocks or growth funds, I should say, still continue to lead the way on the downside. IWO is the Russell 2000 growth. They're all, again, it's all kind of in gear at this point. FFTY is the IBD 50 fund. And then I'll just mention ARK, because ARK's been sort of the worst of the worst. And it's really on the weekly chart. It's very obvious here. I mean, you can see it got down almost to the pandemic lows. I mean, it really got down below where it was the prior few years. So it's been a total wipeout here. Let's see. It's looking like there's support on the week so far. Again, I'm recording this at around 11 a.m. on Friday, so who knows where we close, but it wouldn't surprise me if we could certainly bounce a little bit. Right now, just to give you an idea of how stretched this is, even after this morning's bounce as of 11, it's 24.5% below its 50-day line. So, there's plenty of room to bounce if things want to, okay? And more to the point on that, again, I'm not a it's so bad it's good sort of thing, but just you look at some of these. This is Shopify. Now it's up on the week, which is good, I guess, but it's up on the week and down 78% from its high. Here, I'll just run through some of these. As of right now, it's still 29% below its 10-week line. Cloudflare, NET, just same sort of thing. It's, as of right now, up on the week, it's 32% below its 10-week line. You just on and on. I don't want to run through the numbers, but you're starting to see some of these things. I always get questions on these, and I'm sure I will, and they're fine questions, like once we start to bounce, like, hey, Mike, do you want to play a bounce? My answer is, you can, but I would just keep it small and just realize that these stocks are moving around 5 to 10% on a daily basis. So if you go in there and you're using a 5% stop, chances are you get knocked out at the open or something like that. So you really have to keep it small, use a loose leash, and try to sell on the way up sort of thing. Honestly, like I said, that's not really my game. It can be done. People do it. There's nothing wrong with that. Bill.com is another one, by the way. This was just on my list. You can see it decisive. It had been trying to hold those lows, gap down on earnings, got under 100, and now is bouncing, but still buried on the chart. So let's see. Some of these could bounce. So if you want to nibble and kind of consider them lottery tickets, small positions. I don't think there's anything wrong with that. Just know what you're doing and just understand that, you're probably not going to look back in 2 years and let's say you had a great 2 years from now, you've made a lot of money and say, the key to me making money was me trading those bounces back in, May 2022. Now, the reason you're going to make money is, really the next sustained uptrend. So just keep that in mind, okay? Now, as for individual stocks, which is really where most of my focus is here. This is Halozyme. I've mentioned it before, Halo. It had this long decline, bottomed out. We've talked about this, and it has taken a hit here with the market, a little distribution the last couple of weeks, but still hanging in here. And I just look at this more as it's kind of around the 50-day line, but I just look at this more as this huge kind of trying to emerging pattern, trying to emerge from this consolidation. Earnings estimates aren't great this year because they're paying more in taxes, but big growth projected in 2023 and beyond. I'm not a valuation guy, but 19 times earnings ain't too shabby. And it did report earnings, and it's been up since then, but nothing crazy, just kind of a sharp pullback, and now it's bouncing a little bit. So this one remains on my watch list. It's really not far. Honestly, if it had a couple of good days and set up, and of course the market was healthy, which I'm not saying it's going to happen, but if that somehow happened, this could actually be buyable somewhat in the near future. So it is on my watch list. Still needs work, but good chart, good story. Celsius, this one, so good and bad to this one. Number one is this kind of looks, it feels a little bit like a new Monster beverage, which was a huge winner, kind of a follow-on play there in the energy drink space. It had such a huge move that you do wonder if it's going to be kind of dead for a while. That said, it did fall from 110 to 40, so it's not like it didn't correct and give back a ton of those gains. And actually, the stock has really, this low was in January, and while I wouldn't say we've seen great volume until this week, it has held that 40 level for the most part. And then this week it reported great earnings, way above estimates, triple-digit sales growth, which is one of our big metrics, huge earnings growth, big projections, blah, blah, blah. And then this week's volume looks like it's going to be the biggest since in about a year, something like that, 9 months. It's still below the 200-day line. I'm not saying, it's set up perfectly. But I do kind of look for, and I'll show you another one in a second, where you kind of either dip below support and everyone's getting bearish and then boom, you get that big earnings gap up, or you kind of hold support like this and then, here we go, 1, 2, maybe 3 days in a row. We'll see what happens today. So this one's kind of on my watch list too. It admittedly needs more work. This is something that I could, and this is total me just maybe hoping for it to happen, but this is totally me guessing. But say the market does rally, and say we've put in a low, but we have to build a bottom. This is something where you could see it over the next month. It gets up here, right? And then the market corrects and consolidates or retests or whatever for another few weeks. And then the stock maybe sags, but builds some sort of structure over here. So it becomes a little bit tighter and more under control. I'm not predicting that's going to happen at all, but that's the sort of thing that you sometimes do see at these major lows is these things hold support. They still need work. It takes time to sort of really set up. But you start to see a few of the breadcrumbs initially, okay? Shockwave was the other one, SWAV. This one looked okay here. This was another one. See, this is what always kind of worries you. It had such a big run. You just wonder, just time-wise, does it just need more time? People just need to move on. And it did have a 50% correction. Then it came all the way back. Then it got nailed with the market. But again, this week on earning, very profitable. Again, triple-digit sales, big earnings, big projections, which are probably conservative. And the volume this week on this big, basically wash and rinse sort of thing is rinse and wash, whatever you want to call it, is going to be the heaviest volume since, I don't know, whatever this is, September 2020. So that's just kind of a line in the sand to me. Again, needs work, below the 200-day line. But I'm just flagging some of these that are showing outsized accumulation. Could it die next week? Sure. But the fact that it's, shook out below this low and then immediately pop back up on earnings, usually a pretty good sign. Okay, Lantheus is, I mentioned this. My only fear with this is it's kind of a lone ranger, meaning it's like the only growth stock that actually looks proper. If you were just looking at this chart, you're like, oh, wow, this is a nice bull market in stocks. But shake out to the 50-day line, nice bounce. Nothing wrong with that. Wouldn't mind seeing it chill out for a bit, but it's on my watch list. Boot Barn, this was in top 10 last week. BOOT, again, it had such a huge run. What's interesting, though, is it's not just one of these pandemic, turnaround retail plays like, the things stunk, then they got better. They've really expanded their market. I wouldn't say it's showing amazing relative strength, but the RP line is trending up here. and it's just kind of holding in here. I'm not saying it's set up, but it's got big volume. It could be the heaviest week in quite a while. If we'll see where it ends up. So far, it's kind of mid-range, which is support. You can just see it even as the market's really taken a hit the last 2 months. It's sort of giving ground grudgingly. And it did report earnings this week. It gapped up, reversed with the market. That was one of the bad days this week. Now it's trying to bounce. We'll see what happens. It doesn't have the best earnings estimates, so maybe it just needs more time, but it's something I'm just kind of keeping an eye on. Albemarle, I think that's how you pronounce it. This is the lithium guy. There's a couple lithium plays, this one and Livent, which I'll mention in a second. And, the correction was really reasonable. I think it was about 40%. Then you get this volume clue on earnings. Yes, it kind of shaked and baked this week, but you're 22% off the high. Big earnings this year, growth going forward after that. There's a lot of CapEx here. There's probably more moving parts. There's resistance. But again, just kind of flagging this positive earnings rate. We've seen so many of these, Upstart or whatever, down 50% or whatever it was. When you do see some of these, gap up on earnings, nice follow through the next day, nice follow through the day after that. Yes, it pulls back, but it's kind of hanging in there, high or low. Just some of these things are little clues that can prove worthwhile. And then there's Livent, which is same space. It's a little thinner. I don't want to say thinner. It's not super thin, but it's it's more volatile basically. And you can see the correction again was reasonable. Kind of hit its low back in January, really, and did have this really nice positive earnings reaction. Again, kind of this biggest volume in I don't know, year and a half or whatever. Up and down this week for sure, but looks like support. It's not. There's no real entry point available here, but again, just kind of flagging. Hey, 20 held. 3 times, gapped up on earnings, high or low this week. So those are some kind of growthier stocks that look pretty good. On the commodity side of things, we are seeing, just before, this isn't on my list here, but we are seeing more, it's kind of like commodity stocks are strong. Well, there's definitely more bifurcation. This is XME, which had this nice breakout in February and did have this big run, but has really given it all back. Now, I'm not saying most stocks look like that, but you do have like the Freeport, McMoran's, some of the metals things. So, that's definitely a breakdown. Alcoa, which, had a huge run. I'm not saying these stocks are done forever, but you can see Alcoa actually below the 200-day line down here. So it's definitely more segmented, but there are still opportunities, I think, or could be opportunities going forward. I still like Halliburton. Every week that goes by, I sort of look at it. I don't know where the volume went down here on. There's Halliburton. Okay. But now you're 4 weeks into this consolidation after this big run. Obviously, it could come lower, but each time you can just see these couple of weeks, these tails, it's kind of finding support. It's closing up near the high the last 3 weeks of the week. Just kind of subtle clues. Obviously, the relative strength line looks fine because, this is happening during a market correction. It could easily need more time, but I just keep an eye on it. My thought is, after, just to look at the monthly chart, the stock had all this, it kept coming back to this area. It got destroyed. My guess is that this breakout here from a few months ago, earlier this year, is going to carry further, unless there's a huge sea change out there. But Halliburton's one that I still keep an eye on. Antero Resources, I think I mentioned this last week. So this is, it's really been the leading natural gas play. Again, it went from 22 to 39 here in a few weeks. So a pullback to the 50-day line might not be enough, but so far the stock is respecting the 50-day line. I'm not super aggressive, obviously, here, and just to plow in, I'll leave it up to you, but risk reward wise, this could be a shot, or maybe it bounces and consolidates. We'll see how it plays out, but AR is one that's still kind of acting normally. Devon continues to look good. DVN, it just, for whatever reason, continues to be like, the leading stock. Now it's not early in the intermediate term trend for sure. Even if you consider this breakout right around the start of the year, you've had 3 dips below the 50-day line, but this big rally back to new highs. It shook out on Monday, and you look at the weekly chart. Sometimes it just pays to wait till the end of the week, and it's finding support. We'll see. Doesn't mean it can't pull in more. Intermediate term, I wrote that it's a little bit more 50-50 to me. Like short term, like I don't know, maybe the market rotates. It's had such a big run. Who knows? Maybe it blows off a little bit on the upside, then corrects. But in general, I still think, obviously, the uptrend's intact, number one. And bigger picture, it's the cash flow story remains huge. Elsewhere in the oil patch, this is Civitas. This one hasn't been as strong. And it was one of these that like kind of tried to break out sort of later in the advance. Sure enough, it didn't really work, but you can kind of see it's almost building this, almost like a base on base or whatever in here, and it's been sort of holding the 50-day line. You can kind of see it's been basically holding the 50-day line here, even during some of these periodic sell-offs in the group. So Civi's one to keep an eye on. And then last but not least, I still want this one has earnings in a couple of weeks. In fact, it has it on the 24th of May. This is Starbulk. Shippers have been here or there, but some are starting to come back. And the more I look at this, the more it is a little thinner, FYI, but the more I look at this, the more it just looks like a proper structure with support. Volume's been drying up. Doesn't mean it can't get killed on earnings or there's a rotation, but every week that goes by, the stock really doesn't do anything wrong. And it just seems like it's setting up into earnings, which is one of the few setup, even among commodity stocks, it's one of the few, I'd say legitimate setups. You'd like to see it tighten up. It's up, down, and all around, but it's one of the few legitimate setups out there. So there are still some things hanging out there. But first things first, I think it's just really, you want to do your work with the market. Stay up, keep your eyes open for a turn. Keep your mind open to a turn. I think that's the most challenging thing these days with the Fed and all that's going on in the world. But let's see what happens. I think the first step one is just to get off our knees, okay? And then step two is to see what happens after that, both in terms of the indexes, but also individual stocks. Is all the action in Shopify and Cloudflare and they go up 25% and then they go down 25% the next 3 days? Obviously that's not what you want to see. But up is good, number one, and then the longer we can kind of hold that, the better, okay? We just need to have something to work off of. Right now, ideally, I'm hopeful that Thursday can be some sort of workable low, but, like I said, it's been less than 24 hours since then as I record this, so we'll have to see how it goes. In the meantime, we're just remaining defensive and patient, and like I said, keeping our eyes on the prize for the next sustained advance, okay? That's all the time I have for today. As always, thanks for listening, and be sure to come by again next week for another Cabot Weekly Review.